Tuesday, 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 Tuesday. I hope it's Tuesday, 'cause I've said that a lot.
Hello! Welcome to today's video! Oh boy, I came up with a topic that I enjoy quite a bit. And hopefully it'll be good. But definitely talk about this one in the future. I want to read more books about it, actually. Risk. We've talked about risk a little bit before. We talked about it in the context of insurance, which is that you avoid a small probability of a large downside, such as dying early or having a major health problem, for a small or kind of medium fixed cost over time. I guess the size of that cost depends on your age and your income and all that. So that's one side of risk, which is that we are trying to avoid large downsides. So if you don't have the insurance you need in place, life insurance if you have a kid or if you're married, health insurance for everybody, and a variety of other insurances that you can look up, then go out and get that, because it's important to play good financial defense. But today I also want to talk about the other side. I want to talk about engaging yourself in things that have a small chance of a really big upside, even if they have a potential downside. And how are we going to think about that? Because I think a lot of people don't deliberately consider the role of risk in their life. And if you don't deliberately consider the role of risk in your life, and you don't say to yourself, am I taking any risks? What risks am I taking? What am I going to get back from them? Humans are naturally pretty risk averse. So what's going to happen is that you're probably not going to take very many risks at all, and therefore you're going to miss out on all the potential upside because you didn't even think about it. The first thing I'm going to discuss is just like general investing stuff, concepts. When you invest your money into assets, you are rewarded for taking certain kinds of risks, for taking efficient risks. And what that means is that if you pick a very stable asset class like bonds to invest in, then you're not going to be rewarded. And if you pick a riskier asset class like stocks, then you are going to get rewarded much more, even if they are more volatile. And by more volatile, I mean that they can go up and down much more dramatically. For example, in the 2008 crash, the stock market dropped by about 40%. But if I picked a very boring bond fund, a very popular boring bond fund, it only dropped by 7%. So stocks are definitely more volatile, but they're definitely also a lot more rewarding. Here is a graph that shows what stocks, which is equities, what that has done over time since 1900 versus bonds. So this is a logarithmic scale. This is not a linear scale. If you put, 1 unit into bonds in 1900, then you follow it forward. Now you've got about, what is that, maybe 8 units? Okay, so you got 1 to 8. If you put 1 into stocks, and we follow that, equities, well, this is something more like 400. I don't know exactly what it is. But point is, let's read the description of this. This figure shows index values in real British pounds for various collectibles and financial assets since 1990. Each index is set equal to 1 at the beginning of 1900. I think they meant to say since 1900, but instead they said since 1990. Anyhow, point is that stocks are more volatile, but they have a much, much higher return over time than bonds. Yep. Okay. The way that investors often respond to these different characteristics, where bonds have stability, but stocks have more growth, even if they're more volatile in that growth, is that many times they'll hold a portfolio with both, and then they'll rebalance. It's called asset allocation. What that's going to look like is you will hold, say, 80% of your assets in stocks and maybe 20% of your assets in bonds. And over time, generally speaking, what's going to happen is the stocks are going to increase in value faster than the bonds. When that happens, the bonds are going to shrink as a percentage of your portfolio because the stocks are growing faster. And eventually, the bonds will shrink until they're no longer 20% of your portfolio. They're no longer 19% of your portfolio. They're only, say, and when I say shrink, I mean shrink as a percentage of the portfolio, not drop in value. All this stuff is going to go up over time, generally speaking. Eventually, the bonds will drop to be only 15% of your portfolio. And at that point, you would want to do what's called rebalance, which is to sell off some of your stocks and buy some bonds and do that enough so that bonds are again 20% of your portfolio. If there's a market downturn, it's very likely that the stocks are going to fall significantly faster than the bonds. For example, when they dropped by 40%. When stocks drop by 40%, well, it's probably not going to do it in a day. It's going to happen over time. So let's say the stocks drop from 80% of the portfolio, and now they only make up 75% of the portfolio. Well, then you would sell off some bonds, and you'd buy stocks until you were back up to 80% of stocks in your portfolio. The impact of this is that having the bond section of your portfolio allows you to buy more stock when the stock prices fall. And of course, buying low and selling high is what gets us rich when it comes to the stock market. So it cushions the blow of the stock market falling. But it has the reverse effect when the stock market rises, because it takes out money from stocks when they rise and puts it into bonds. So that money can no longer continue earning dividends in those stocks because it's sitting around in a bond. Overall, what we're doing with this is we're decreasing volatility. We're still holding mostly stocks, but our total portfolio value has less dramatic swings up or down over time. In fact, the kind of classic portfolio has been 60% stocks, 40% bonds. Recently, though, bond yields have been so poor that a portfolio with 60% stocks and 40% bonds generally cannot reach most people's investing goals, either in terms of growing enough over time to get them to financial independence, or in terms of kicking off enough cash flow to pay for them in old age. I'm going to post this article in the description so you can look over it yourself. And yeah, the number in terms of like what a stock or a bond would be after a certain number of years. I did this based on a different set of assumptions, based on stocks being 7%, bonds being 2.5%. The particular difference between them is not important. The important concept is that over 20 or 30 years, that difference is big. That difference is so big that it's something that you have to pay attention to. All right, so as I've studied more of this personal finance, investing, financial independence stuff, it seems basically that there's kind of two camps of people. There are the people who believe that you should hold stocks and bonds, and as you get older, you should shift more towards bonds to decrease the volatility. And there are the people that they just think you should hold 100% stock all the time and get as much gain as you can. And that basically the gain will shield you from the volatility. Because if you have twice as much stock, but it's volatile, versus ending up with half as much wealth over time because you invested more in bonds, the volatility doesn't matter because you just have so much more money that, you know, your worst year is better than the other person's best year. I am in the camp of people who believe that you should be 100% in equities. And if you don't want to be in equities, you should be in real estate, but not bonds. And the reason why I'm in this camp is because I think people have a lot of power, generally speaking, to reduce their fixed costs. And when a person pays attention to their spending and reduces their fixed costs, it removes a lot of the risk associated with the volatility of the stock market. If we do have another 2008 and your stock portfolio falls by 40%, having low fixed cost means that for that year, you can just not spend a whole lot of money and you won't have to sell off those low-priced stocks. Though, generally speaking, the stock market is not down for more than 2 years. The Great Depression is an exception to that. The Great Depression took 2 years to get to the bottom of the stock market. It wasn't back to its previous level if you were invested in the whole market until 1936, so that's 7 years. So it was, I mean, they call it the Great Depression. That's a long time. But this, Great Depressions don't happen every 10 years. They're uncommon. I think also that if you're really old, okay, fair enough. Like, you are likely living off of, a portfolio or a pension, and it's much more difficult to get a job. If you're younger and a Great Depression happens and you're holding 100% stocks, you can still hustle and work your way through the Great Depression without selling all your stocks and living off of that saved money. So I think that's why I'm on the side of holding 100% stocks, certainly for me. I think that when you get to someone who's older, it's a more difficult question because they are less adaptable and they may have higher fixed costs simply due to medical conditions. But if you're younger and you still have 20 or 30 years ahead of you, 15 years for that matter, then I think 100% stock portfolio is the way to go. And if you're not comfortable with the 100% stock portfolio, which, given how inflated the market is, which I've discussed before, I can understand that, then I would look into investing in real estate, and I would look into, can you find a deal in real estate? Because I don't think that you're going to find a deal in the bond market. And the final thing I'd like to point out is that when I talk about the virtues of low fixed costs, I do not mean that a person does not have nice things. What I mean is that the person's nice things do not regularly cost them money over time. Or that if a Great Depression happened, that super nice set of speakers you bought that breaks doesn't need to be fixed. You don't have to spend money on it. The speakers can be $100,000 speakers. Who cares? The point is that they are not vampire speakers requiring payments in the future when you can't guarantee that you'll be able to make those payments and reach your financial goals. We need some adaptability here to get the best possible investment outcome. So those are my thoughts on risk today and arranging your life for risk and what kind of rewards you get. I need to nail down some numbers on these bond and stock returns that I feel better about explaining. That's for sure. But yeah, think about what risk you're taking. Are they smart risks? Are they stupid risks? Buy insurance if you need it. Protect your downside. And embrace the benefits of keeping low fixed costs so you can take some risk on your long-term investing. All right, that's it. Have a great Tuesday.